High-yield REITs always look tempting. A big dividend, a diversified portfolio, long leases, real estate that businesses need to keep operating. That is the basic appeal of WP Carey, ticker WPC. But in 2026, investors should not look at WPC and ask only one question. What is the dividend yield? That is not enough. The better question is this. Is WP Carey a durable, high-yield REIT with improving cash flow, or is the market still worried for a good reason? Because WPC has an attractive income story, but it also has a recent dividend reset, tenant risk, debt, interest rate sensitivity, and valuation risk. So in this video, we're going to break down WP Carey as a high-yield diversified REIT. We'll look at the business model, the portfolio, the dividend, AFFO, guidance, risks, and whether WPC is actually worth watching in 2026. A high yield is attractive, but only durable cash flow makes it useful. WP Carey is a diversified net lease REIT. In simple terms, the company owns commercial real estate and leases it to businesses. Its current focus is mainly on operationally critical real estate. That includes industrial properties, warehouses, retail locations, and other business-use properties. WPC has exposure in the United States and Europe, and the company is not small. At the end of the first quarter of 2026, WP Carey had 1,703 net lease properties. Those properties covered about 185.3 million square feet, and the portfolio served 374 tenants. That gives WPC a different profile from a REIT focused on only one property type or one market. The basic idea is simple. WPC owns real estate that many businesses need to keep operating. But to understand why investors like this model, we need to understand how net lease real estate actually works. The net lease model can be very attractive when it works well. Here is the simple version. A tenant uses the property. The tenant pays rent. And in many net lease contracts, the tenant also covers property-level expenses like taxes, insurance, and maintenance. That can reduce the operating burden for the REIT. It can also create a more predictable rental income stream. Net lease REITs often benefit from long leases, rent escalators, and lower day-to-day operating complexity compared with some other real estate sectors. That is why investors often see net lease as boring in a good way. But there is one condition. The tenant has to keep paying. If tenant quality weakens, if a tenant goes bankrupt, or if a property becomes hard to release, the model can become less boring very quickly. Net lease can be boring in a good way, but only when tenants keep paying. And this is where WP Carey's diversification becomes important. WP Carey is different because it is diversified across several dimensions. It is diversified by property type. It is diversified by geography. It is diversified by tenant industry, and it is diversified across hundreds of individual tenants. That matters because a single sector REIT can be more exposed to one specific trend. For example, a pure retail REIT depends heavily on retail. A pure office REIT depends heavily on office demand. A pure industrial REIT depends heavily on industrial real estate pricing and tenant demand. WPC is broader than that. The company also had a weighted average lease term of 12.1 years at the end of the first quarter of 2026. That gives visibility into future rent, and its top 10 tenants represented 18.3% of NET ABR. So WPC is not a one-sector REIT. It is a diversified net lease machine. But investors also need to understand the reset that changed the story. One of the most important parts of the WPC story is the post-office reset. WPC reduced its office exposure and moved toward a cleaner net lease portfolio. Strategically, that can make sense. Office real estate has been one of the most challenged sectors in commercial real estate, so reducing office exposure may help create a more focused, simpler, and more durable income story. But there was a cost. WPC also reset its dividend during that transition, and for many income investors, that matters. Dividend investors do not forget dividend cuts or resets quickly. Even if the portfolio becomes cleaner, investor trust takes time to rebuild. So the current WPC story has two sides. On one side, the company may be more focused today. On the other side, the market still remembers to reset. The office exit may have cleaned up the portfolio, but investors still remember the dividend reset. Now, the key question is whether the current numbers show real improvement. WP Carey had a strong first quarter in 2026. AFFO per share was $1.30. That was up 11.1% year over year. Revenue was $454.5 million. The quarterly dividend was 93 cents per share, and that equals an annualized dividend rate of $3.72 per share. Those are important numbers because for a REIT like WPC, AFFO is one of the most important cash flow metrics. A dividend story without AFFO support is weak, but a dividend supported by improving AFFO becomes much more interesting. Still, one quarter is not enough. Investors need to ask whether the improvement is durable. WPC had a strong quarter. The question is whether the growth is durable. And the 2026 guidance gives us the next piece of the story. WPC raised its 2026 AFFO guidance. The company now expects AFFO per share between $5.16 and $5.26. That is a positive sign. WPC also expects investment volume between $1.5 billion and $2.0 billion, and contractual same-store rent growth was 2.4% in the first quarter. This tells us the company is not just sitting still, it is trying to grow through contractual rent increases and capital deployment. But this also creates an execution test. New investments need to be attractive, cap rates need to make sense, the cost of capital needs to work. Tenant credit matters, and management has to deploy capital without overpaying. The guidance is better, but WPC still has to deploy capital wisely. And for income investors, the next question is obvious. Can the dividend be supported? The dividend is one of the biggest reasons investors pay attention to WP Carey. The company declared a quarterly dividend of 93 cents per share. That equals $3.72 per share annualized. Based on the quarter-end share price, the dividend yield was listed at 5.5%. That is attractive, but yield by itself is not enough. The dividend has to fit inside AFFO. In the first quarter of 2026, WPC's dividend payout ratio was 71.5%. That looks more reasonable than a payout ratio that is too stretched, but investors should still watch the trend. AFFO needs to keep supporting the dividend. Rent growth needs to continue. Tenant credit needs to hold up. Debt costs need to stay manageable, and acquisitions need to add value. The dividend looks attractive, but the AFFO has to support it, because without cash flow support, high yield can turn into a trap. The first major risk with WPC is the yield trap risk. A high dividend yield can attract investors very quickly, but sometimes a high yield exists because the market is pricing in risk. That is why investors should never analyze WPC only by the dividend yield. They need to look at AFFO payout, debt, rent growth, tenant quality, valuation, and the recent dividend reset history. A high yield can be a real opportunity if cash flow is durable and the stock is reasonably priced. But a high yield can also be a warning sign if cash flow is weak or declining. That is the difference between income and illusion. WPC's current payout ratio looks more manageable, but the market still wants proof that AFFO can grow, tenants can keep paying, and the dividend can remain supported. A high yield is not a bargain if the cash flow cannot grow, and that leads to the second risk, tenants and credit. WP Carey is diversified, but tenant quality still matters. At the end of the first quarter, WPC had 374 tenants. Its top 10 tenants represented 18.3% of net lease ABR. Investment-grade tenants represented 21.6% of ABR, and occupancy was 98.1%. Those are useful portfolio metrics. High occupancy is a positive sign. Tenant diversification helps reduce single-tenant risk, and long leases can create visibility. But none of this eliminates credit risk. Tenants can weaken, industries can change, properties can need releasing, and not every tenant has the same financial strength. So investors should not look only at the number of tenants. They should also ask what kind of tenants they are, how critical the properties are, and what happens if a tenant stops paying. Diversification helps, but tenant quality still matters. And beyond tenant risk, WPC still has to deal with the capital side of the REIT business. WP Carey is a real estate income story, but interest rates still set the rules. At the end of the first quarter, WPC had net debt to adjusted EBITDA of 5.7 times. Including unsettled forward equity, that ratio was 5.3 times. The weighted average interest rate was 3.2%. The weighted average debt maturity was 4.8 years, and liquidity was about $2.84 billion. Those numbers matter because REITs depend on capital. They borrow, they issue equity, they buy properties, they refinance debt, and they try to invest at returns above their cost of capital. When interest rates are higher, the math gets harder. Acquisition spreads can shrink, valuations can compress, and dividend stocks have to compete with other income options. WPC is a real estate income story, but interest rates still set the rules. And this is exactly why we do no-hype REIT analysis. This is the kind of REIT analysis we focus on at Boring Money Wins, not just asking how high the dividend yield is, not buying a REIT because the payout looks attractive, not ignoring AFFO, not ignoring tenant credit, not ignoring debt, and not pretending that high yield automatically means high value. If this kind of practical investing breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more clear investing content to people who want analysis without hype. Now that we understand WPC's income story and the risks behind it, let's compare it with other net lease REITs. When investors look at WP Carey, they often compare it with other net lease REITs. Realty Income is the famous monthly dividend name. It has scale, brand recognition, and a long income-focused reputation. NNN REIT is often seen as a more conservative retail net lease operator with a long dividend track record and a focused strategy. WPC is different. It may offer a higher yield. It is more diversified by property type and geography. It has US and European exposure, but it also has the recent dividend reset in its history. So the comparison is not only about yield. Investors should compare AFFO growth, dividend safety, payout ratio, tenant quality, balance sheet strength, property mix, and valuation. WPC may offer more yield, but peers may offer different kinds of confidence. That is why the right answer depends on what kind of investor you are. WPC may appeal to investors who want income. It may fit investors who want a diversified net lease REIT. It may also appeal to investors who like long leases, operational real estate, AFFO analysis, and the portfolio that is not tied to only one property category. But WPC is not for everyone. Investors should be careful if they are only chasing yield. They should be careful if they expect explosive growth. They should be careful if they ignore debt. They should be careful if they ignore tenant credit. And they should be careful if they want absolute dividend certainty. No REIT dividend is guaranteed, and WPC's recent reset means income investors should do more work, not less. WPC may fit income investors, but not investors who only chase yield. So now we can bring everything together into the final verdict. So is WP Carey worth buying in 2026? The balanced answer is that WPC is worth watching but not blindly chasing. It is a diversified net lease REIT. It has high occupancy. It has long leases. It has a meaningful dividend. It raised AFFO guidance, and its current payout ratio looks more manageable. But there are still risks. The dividend reset still matters. Tenant credit still matters. Debt still matters. Interest rates still matter. And valuation still matters. WPC can be attractive if investors treat it as a cash flow analysis, not just a yield play. The best high-yield REIT is not the one with the biggest dividend. It is the one where the cash flow survives. That is the boring answer. And boring money usually wins because boring money usually survives.